Hi traders, welcome to this video. Today I want to go with you over 5 trading rules from William O'Neill. Who is William O'Neill? William O'Neill is the founder of Investor Business Daily, or IBD. It is one of the first newspapers, or the only newspaper which focus on growth stock. And William O'Neill also founded a lot of products, institutional products and products for retail traders around growth stocks. He wrote a very famous book which I recommend to read. This is How to Make Money in Stocks, a very classical and a very, very good book about growth stocks and investing in stocks in general. I selected 5 rules from him. Of course, he had a lot of more rules, but I selected 5. And let's start with the first one. Don't buy cheap stocks. Buy stocks mainly selling above 15 to 20 US dollar. A lot of people focus on cheap stocks or penny stocks. The thing is, the price of a stock is very important because higher priced stocks mostly have a better support from institutions. A lot of institutions are not allowed to invest money into cheap stocks, and of course not in penny stocks. And you need institutional power for big trends in the stock market, because institutions are the ones who create and support trends, and they investing millions and billions into the stock market, and sometimes millions into single stocks. And they have the best researchers in the world, and they focus on stocks, and they discover stocks, and they analyze stocks in detail. They know more. They sometimes have the direct connections to CEOs and to companies. And if they start to buy a stock and put a stock on their list, on their buy list, you can be sure that they analyzed the fundamentals and the perspective of a stock very deeply. And if you look at penny stocks today, or very cheap stocks, they also are not liquid. I personally trade stocks which have around $20 million traded volume per day, and at least 100,000 or better 300, 500,000 traded shares per day. They are very liquid. I can enter and exit without any big slippage in a second, or with one mouse click. And if you look at penny stocks, for example, they are cheap for a reason, because the company itself is often not or has no high value. They have a very small market cap. They don't have mostly any profits. Sometimes they have a big growth, but the growth is absolute marginal. If a company has a revenue per year or per quarter of 1 million, that's so small that no institution will look at it. And don't make the mistake that you think you are smarter than the institutions or smarter than the market. There are a lot of companies which sell for $1 or for a penny and have revolutionary products. But very often it's the case that the company goes bankrupt very quickly because the product will not sell or has problems or or is a fake in general. So focus on liquid stocks, and liquid stocks are often not cheap. And focus on institutional quality stocks, and they are not cheap. There's a reason why Amazon or Apple or Netflix or whatever, why they are selling at $100 to $2,000 per share. You know, they have a very big market cap. And that's often the case because the company produces so much value for investors and for their consumers that they have such a high value. So have that in mind. Don't buy cheap stocks. The second one is respect CANSLIM rules. CANSLIM is the acronym for a concept or a trading system invented by William O'Neill, and it based on the work of other great investors, you know, like Gerald Loeb or Bernard Baruch or Jesse Livermore and so on. And William O'Neill did a great work of research. He goes back to 1880 and looked at all the biggest winning stocks in history and found what they have in common. This is the base for the CANSLIM system. And CANSLIM stands for current earnings, annual earnings, new product, service or management, supply, leader or laggard, institutional support, and M stands for market direction. And inside this concept, every part of successful stock trading is included. So I highly recommend to read his book, and I highly recommend to have a deep look into the CANSLIM rules and areas. Third trading rule: look for new America companies instead of old America companies. The thing is, every stock market cycle and every big stock market trend is always or mostly led by new companies and often unknown companies. You know, if you look back in history, companies like Apple, like Netflix, like Shopify, like Coupa, they were unknown at the time when they started their trends. And if you go back in history and if you look at companies like General Motors or other companies 100 years ago, they made big moves when they were unknown to the most market participants. And only young companies, only new companies which have revolutionary, disrupting products, they are able to produce a big growth. Old sectors, something like banking, insurance, cars or something, they are not able to produce big growth anymore. You know, they are happy when they have the same results at last year, and if they maybe can optimize their income streams and make a little bit more profit. That's all. You know, but if you look at young companies which are disrupting their sector and disrupting their markets, they produce big growth. They get more market shares. They found new ways to make more profits. They found new ways to sell products, and they invent new products. And this is what drives the economy, and this is also what drives the stock price. So look always for young revolutionary companies. The fourth rule, forget your pride and ego. The market doesn't know or care what you think. You know that from other videos, I always say the market is always right. You know, as a trader, I have opinions about stocks and I have opinions about the market, but the market doesn't care about my opinions. The market will do what the market will do. That's so simple. You cannot influence the market as long as you don't have billions or trillions of capital. And also in that case, if you have billions of capital, it's very hard to influence the market for a long time. So, and what you want to do as a trader, as a small retail trader, you want to go into the market direction. You want to be in sync with the market. And if you are not in sync with the market because you have a different opinion and you think, oh, the market will fall, but the market is going up, then you will lose money. So, and you always have to make sure that you trade in the market direction when you trade stocks, because 75% of all stocks go up and down with the market. And forget your pride and ego. Be in sync with the market. So the fifth rule, don't buy bottoms and don't average down. Bottom fishing is very, very hard. If you try to predict where a correction will end, you will often lose money. So, because, every correction starts with a small correction. A 5 correction will turn into a 10%, a 10% will turn into 20, a 20 will turn into 50, a 50 will turn into 75, and so on and so on. You can see, or you can look back in the history, you find good examples for companies which go bankrupt, and they all started with a very small correction. And it's very hard to predict a bottom. You can always see where is the bottom in hindsight. And the thing is, you don't need to predict bottoms. It's really not necessary. What you want to do is you want to buy the stock at the right time when the large trend starts. And you don't want to buy a stock as cheap as possible. That's not this is not needed. If you have a stock which will go up 100% in a few months, it doesn't matter if you catch the first 10% of the move. If you have sound rules for adding to your position when inside a trend, and you buy more shares when the stock is going up, then you don't care about the 10% or the 15% from the bottom. You only care about the 90 or 80% in the middle of the move, and this is what counts. And if you focus on that to buy the stock when it breaks out of a sound base, and then you buy into or scale into the trade and add to your position on the way up, you don't need to buy bottoms, and you avoid a lot of pain and a lot of losses. The second part of this rule is don't average down. What William O'Neill said is, don't buy more shares when the price is falling. I always add to my positions on higher prices. I always average up. I never average down. And why I don't average down? Because if a position is showing me a loss, it's a sign for me that I'm wrong about the trade. I maybe caught the wrong entry, or the market is not in the right mood. And in that situation, I don't want to I don't want to throw good money after bad money. I want to exit the position. I want to reduce it. I want to reduce my risk, and I don't want to add to my risk. And average down. There's a very famous quote from Paul Tudor Jones, which said, "Losers average losers." So, and what he tried to say is, only losers, so only people who are losing money, are averaging trades which show a loss. And that's the same case here. Don't average down, which means don't put money into your losing trades. Put money into your winning trades. Because if a stock started to correct, the odds are higher that the correction will continue, which means the trend will continue and not turn around and goes up. So you want to always put your money in the chances with the highest odds. And that means in the direction of the trend. And that means don't average down. Okay, yeah. That was a short introduction into 5 trading rules from William O'Neill. Again, I recommend read his books and go to investors.com, Google William O'Neill and read more about him and his philosophy of trading. He was a very, very successful trader, and he gave he was an inspiration for a lot of other traders like Mark Minervini or James Ruppel or David Ryan, of course. And he gave a lot of very, very good, simple to understand rules to a lot of traders. And there's a rumor about William O'Neill that his company and his trading rules created the most millionaires in the USA. So definitely have a look at William O'Neill's work. Okay, if you want more of this stuff, follow me on Twitter. You can follow me also on YouTube, and I recommend to subscribe to my free newsletter on julian-comar.com. And I send it out every Sunday with trading tips and also 4 trading candidates from my personal watch list.